being in this business, as long as I've been in this business, one of the common questions that eventually always comes around, people either will ask it or they're thinking it is, when would I get in? When would I get in? When would I get out? What are the tools to give you some predictive skills? Well, when there's too many longs, like there are in here, that was a cue the market was going to go down. But from here, and it does go down, all right, all of a sudden, short comes in. Do you buy it on that? Nope, not necessarily. But there's this purplish box. What is that? That's a big order of over 100. That's a sell market order. If the market doesn't go down pretty quickly, when there's a lot of big selling, you got to scratch your head. All right. But you still have these longs. Let me just play it. And you'll see more shorts come in. Now you want to see these greens or longs file back. What we call our laser in here, go from small green to maybe red. So more red, less green. If you were looking to buy this pullback for a pop, you're bullish, you're looking for a retracement. Still too many longs. Now you got some reds that came in. And you got the laser, what we call laser, go green to red. Now here's the key. This was the big one. This is if you're bullish and trying to qualify retracement to buy. If you didn't do it at this point, based on what we have and what we show, then you weren't really bullish, or you didn't have the appropriate skill set to know too many shorts probably going up. Let me back it up a second. This right here was a little bit of an inflection point where reds kind of grew. Market went up just a little bit, and this green 15 goes red. Let me play it. Long comes in, so you're still waiting. All right, let me wait. He files down. It goes red, meaning this laser. Some more shorts come in here. Boom, that one right there. Not only did shorts come in at 77 3/4, but this gray line indicates they're probably short and want a bid to get out right away. That's the anxious buyer in a negotiation. We talked about during the room. When there's something obvious that you know as the seller that the buyer is anxious, then you let him negotiate with himself. Because in trading, it's a constant negotiation between buyers who want to buy it, buyers who did buy it, sellers who want to sell it, or sellers who did sell it. Longs, shorts, everything else. And so when you get a short, he turns into a buyer. If he's an anxious buyer, the probability upside is the right call. The timing, the location, the ability to say when, the ability to strip out the randomness, to see it continue to go up isn't a good guess anymore. And until you strip out randomness, you'll never be consistent. Until you have tools that strip out randomness, stack probabilities to not only tell you the when moment, but sooner rather than later, let you know if you're right. The first thing that tells you if you're right or wrong is going to be price. So if you get long and it goes your way right away, it's probably the start of a good location. If you get long and it goes right in your face, well, that's the start of a bad location. Price is going to be the first thing to tell you. When you get these things stacked up, you get less longs and more shorts that piled in down here around 76. When you get the laser going from green to red, these are counting shorts and longs that are stuck. When you get a big aggressive sell order that punched the market in the face and it didn't flinch, then you get this guy coming in. This is order flow essentially being read for you. The continuation isn't a surprise. Another big seller, boom, boom. And both of them couldn't get the market to go down. Big buyer, 111, he gets the market to do what it's supposed to do. That's not a clue. When the market does what it's supposed to do, there's no clue there. But when the market doesn't do what it's supposed to do, that's the head scratch moment. That's the tell. First off, you have to know what the market's supposed to do, and then you have to have the wherewithal to know that conventional wisdom is BS in trading. It's knowing the conventional wisdom and doing the opposite, and knowing when the opposite has the probability of working. You get more shorts pouring in. Now watch what happens to kind of telegraph the top of this move. All of these longs coming in and the gray lines. The gray lines are the offers of the longs that come in. All right. Starts to telegraph that the top might be in. He goes away, market goes up. They come back in, market comes back off. Big buyer, they laugh at him. Look at this big buyer here. Let's just rotate this down in real time. Look at this combination. So first of all, the long comes in, these longs come in, and you're like, okay, downside might be the right side. As soon as they go away, it's like not so fast. Plus the laser didn't turn green. You want it to turn green. So it comes up. Another series of longs come in right in there, but this big buyer comes in and the market says, that wasn't something that knocked us down. If a big buy order comes in, it should knock the market up. When it doesn't, it's the clue. Then you add all these longs. Then you see the laser turn. You can anticipate the laser turning before it turns. But when you get this, let me play it in real time. Bam, bam. What are the two bams? The first bam is the big buy order coming in and market doesn't shoot up. It just stays there, and eventually gets below them. That's bearish before it's bearish. More longs than shorts is bearish before it's bearish. Gets below this guy where he was satisfied when he came in because it went up. You'll start to squeeze him. Fast forward it goes down, speeds up to the downside, no coincidence. Everybody has tools that they use to predict where price is going. However, most people don't know and can't explain why price moves in the first place. I'm going to do a kind of a YouTube channel wide session on why price moves. And if you don't know why price moves, with the ability to explain it to somebody else so they could say, oh, okay, yeah, that makes sense. Well, then you have no business trying to predict it. If you can't explain why price moves so somebody else can understand it who does not trade, then you have no business trying to predict it. You have to be able to explain why price moves, and then you have to look for those conditions in a predictive manner in order to put yourself in good locations to be long before it rallies, to be short before it breaks. You can't use price to predict price. That's like saying, I think it's going to rain after you're wet.